We'll have this conversation in English. So, well, first of all, thank you, Dan. Thank you, Stephen, for joining us and spending some time with this audience here to talk a little bit technical, but for people to understand. Actually, at the end of the day, we only want to update the entire system, but it's important to understand what's going on under the hood. I want to talk a little bit about infrastructure and interoperability. Well, I have a challenge here of the first to not to say interoperability all the time, so I'll go to interop all the time. Cool. And real world meets Onchain, you know. So Brazil already runs instant payments with Pix, and globally we see digital settlement with stablecoins and tokenization gaining a lot of traction. But to understand how the plumbing behind this, you know, in terms of interop for Wormhole and institutional custody and infrastructure for Fireblocks, that changes the daily work of issuers, digital assets platforms like MB, asset managers, and other players in the financial industry. So I'm going to start with Dan, talking a little bit about interop and what Wormhole actually does. Then when we talk about interop, what real business problem comes to your mind? You know, is distribution? Is it finding investors, finding other issuers across different networks? Or is it merely technical, you know, of taking an asset from one chain to the other?
Yeah, thanks everybody. So the business question that you'd be asking if you're thinking about interoperability or interop is if we're launching an asset on chain, how do we go about that in the best way to scale to as many users and to as much liquidity as possible? I think an example even from the real world is any business, any application, let's call it Uber. Uber launched in the United States, let's just call that Ethereum. But they didn't want to just launch in the United States. They wanted to launch a global business. They wanted to maximize their users, maximize their revenue. So what did they do after the US? They scaled to Asia. They scaled to South America. This is how asset issuers now are thinking about blockchains. Launching something on-chain, which is a word that you will hear a lot more now. It's similar to the word online. We call on-chain being on a blockchain, but in today's world, we talk about on-chain as in on all of the blockchains that have users and liquidity. So launching on a blockchain does not mean launching on Ethereum, and it doesn't mean only launching on Solana. It means launching on Ethereum, Base, Solana, all of the top 10 to 20 blockchains. So this is really, I think, high level what we mean by interoperability.
So as an issuer, which metrics should keep in mind? Does the choice, we talk about liquidity fragmentation somehow, does the choice of network truly matter?
Yeah, there's a lot of metrics that you can look at, some practical kind of links to give you guys. Token Terminal is one. DeFi Llama is another website that you can check for on-chain statistics. But one I would say is total value locked. This is a common statistic used to track how many assets are locked in decentralized finance applications on various blockchains. Ethereum has, last I checked, was around 60 to 65% market share in total value locked. But you're not going to ignore the other 35% of value that's being deployed into decentralized finance and other chains. Another one is transactions per second. If you're thinking about launching not just an asset, but launching an app on blockchains, if you're a finance company, you're sometimes going to be gearing your application towards throughput and speed. If you're doing an exchange, for example, Ethereum, as an example, can do about 15 transactions per second. It was a slight innovation on top of Bitcoin. Solana, taking it to the next level, is about 1,000 transactions per second. When you gauge it in a kind of a practical level. And then there's even new blockchains coming out. I would mention Monad, I would mention Fogo as some of these blockchains that are going for 10,000 transactions per second, which gets you closer to kind of a credit card processing company. And then let's see, that's TVL, that's transactions per second. And then I would say the last one is users. Monthly active users, Ethereum, like I said, has a lot of the volume, Solana actually has the most monthly active users. They've got around 40 million monthly active users to Ethereum, who has about 9 million monthly active users. So although Ethereum has a lot of the value, Solana has a ton of users because the user experience there, if you've ever used Solana-based applications, or you could download the Phantom wallet to kind of like experiment with this, which I highly recommend if you're looking to get your hands dirty and learn more about DeFi. Solana's got a lot of value there in terms of users. So there's a few metrics you can look at.
All this fragmentation, and these different approaches of the different chains makes Fireblocks and Stephen's job much harder. Is it fair, Stephen, to say that the industry is rebuilding parts of what we know as core banking on top of blockchain, managing keys, policies for who can do what, different settlement workflows, or is it something that are we missing here on this upgrade, to a more on-chain infrastructure?
Yeah, I would say, look, I think what you're seeing being built is a reflection of financial services happening with a new technology apparatus, right? So, I think if you think about just look at stablecoins, right? Where did stablecoins evolve from? They evolved from the fact that traditionally you had exchanges that were all over the globe, and the ability to move money across all those exchanges by firms that were non-banked was very complicated. So you had dollars in the US, but if you wanted to trade in Korea or in China or in Asia or anywhere else, you couldn't move those funds very seamlessly. So this idea of bringing money on chain would allow folks to be able to allocate capital and then be able to trade. You had that then start to evolve, right, with the idea of how do you then manage, the funding across exchanges. So generally speaking, pre-FTX, you would either have non-funding, right, or you have pre-funding, right? And basically after FTX, this idea of lack of pre-funding was a big issue, and so everyone needed to pre-fund. Now, if you don't have traditional banking institutions, you don't have the idea of prime brokerage within the space, the ability to allocate capital more efficiently across the board, right? And so what did you start to see, and I think the BlackRock example was very interesting, is that you started to see this idea of tokenized money market funds, right? Now, those tokenized money market funds were generally driven by the fact that crypto native firms were still not being banked, and there was a need for additional yield, right? And that was step number one. But what do you have when you have additional yield is this idea of starting to prime broker yourself, right? And so you start to see the innovation occur in which now folks start to take tokenized money market funds and they're putting it as collateral for the needs for trading. So you can post that tokenized money market fund across an exchange. You can still earn relative yield, but you can use that as a collateral basis for exchange-based trading or for decentralized trading, right? And so what you're seeing is just this creation of new models, leveraging new technology. I still think you have additional problems. You don't have netting within trading. You don't have the ability to allocate capital across various exchanges for capital efficiency. But you're seeing those problems start to get solved at a technological basis rather than a more centralized basis. And I think that's really where a lot of this infrastructure comes from. And so as you think about where things like tokenized assets come from or will be going, I think it's the ability for you to allocate and acquire those assets, but also be able to deploy those assets very seamlessly across the different networks. So it shouldn't matter if you have a tokenized asset that's deployed on Ethereum. It should be easy to allocate that across the basis to a Solana-based DEX or to another DEX on another ecosystem in a very simplistic way. So I think that's kind of where the broader nexus is going.
We see, of course, stablecoins, are the super hot topic, in the last 2 years at least. And we see a lot of movement, a lot of innovation, going on stablecoins to make it easier to use, a lot of UX. Roberto Campos was saying something related to the user experience, that apps targeting, the final user that they are using stablecoins without even noticing. Do you think that stablecoins are being kind of a large, laboratory, a large experiment, for the next level, for example, implementing all this innovation around stablecoins to other digital assets like tokenized assets?
Yeah, look, I think why is tokenization so interesting? It's the first viable commercial model that potentially has the impact on the retail masses, right? So you have crypto trading and more speculative trading, right? But then you have a tool or a technology that's being used across normal everyday use cases, right? And really the efficiency of the technology is the driver there, right? And so the idea of like cross-border remittances and corporate payments on a cross-border level or is done at a basis of solving a problem today, which is that payments on a cross-border level are still somewhat slow. There's T+1, T+2, T+3 settlement times. There's two-sided FX that needs to occur. And the question is, what happens when money moves more instantaneously and what value can be realized across the board? And so I think that is why you're seeing so much exploration around this, is because at the end of the day, you can extend a technology such as a wallet, and you can extend the access to the blockchain, which will allow people to take advantage of the technological capabilities, which is how do you move money more simply and faster, right? And how do you gain the utility that a user sees behind that? And so I think that's just like the first example that we're seeing at a retail level. I think it'll be very interesting to see like how that continues to evolve as we start to think about yield being derived across those bases, as we start to think about like the idea of capital efficiency, as you start to see about the idea of like mitigating like FX risk for like localized currencies. Like there will be problems that are solved around that, and those will in its way find itself into like corporate type activities, whether that's trading or corporate payments, but also on the retail side in my view.
Yeah, just to put stablecoins into perspective, the total issuance or total market cap of stablecoins today is around 290 billion. And I looked up the GDPs of the various countries in Latin America. That's the same size as about Chile and the same size as Peru. Just to put that into perspective, the amount of stablecoins that are being used, and this is growing at an exponential rate. Another thing, just I think a trend to watch in the stablecoin space is the yield aspect. USDT is by far the biggest stablecoin issuer. USDC or Circle is the second biggest. These businesses are absolutely printing money, but I'm not sure how much longer that's going to last before competition catches up to them, for the main fact that those two companies are keeping all yield for themselves. They're taking in $1 for every dollar that they're issuing into the market, and they're earning 4% on all the T-bills that they're holding in the bank, and that's how they're printing money. But there's a lot of other competitors now. M0 is an example, Agora is an example, who are stablecoin platforms. They're allowing people to easily build stablecoins using their platform, but they're allowing those stablecoin issuers to enable yield to be given to either the application that they're being implemented in, or even giving it to the user who's holding those stablecoins. Because if I'm a user, I don't want to be sitting and holding USDC just plain. I'm losing money. I'm losing the money that Circle's earning while I hold that, but I would hold a stablecoin that's earning 4 to 5% going directly into my decentralized wallet.
Yeah, I think that stablecoin has this first, killer use case of tokenization, and we're discussing another panel, how this will evolve, if it's a winner takes all business or no, if there's be a lot of competition and somehow, harmonical level of many different projects. But, we're talking all the time, you get to fragmentation, and that's take us to interop again. Do you think that integrating, then the crypto space and blockchain infrastructure to the legacy systems, do we have to, throw away everything we built, to rebuild it on chain, but it's already, a patchwork? How to deal with that, a new system that is being born right now, in the last 15 years, is already a patchwork. How to integrate that to the legacy systems, that are already so fragmented?
Yeah, it's a tough one. I know there's some blockchains. One is called Canton. It's launching pretty soon. They've taken the approach of doing everything in Java, which is the language that I believe is used by a lot of the legacy banks. So that was their approach to kind of meet the banks where they are. Another example is Google. Google Cloud is launching something called Google Cloud Universal Ledger, or GCUL. They, interestingly, are doing all of their transaction fees at the end of every month in US dollars. So there's no concept of paying fees in ETH for Ethereum transactions or Sol on Solana. They're, again, meeting businesses where they are today and making it easy to fit into their current processes, which I think is very smart. On the user side, I do think we actually honestly have a ways to go in terms of user experience. Things are improving significantly, especially since I came into crypto 7 years ago, but there's still a lot of work to be done. If you go through the experience of trying to onboard, I don't know, your mother or your sister to crypto, you start to quickly see that we've got a ways to go before we can give the easy Apple-esque experience of using crypto.
Yeah, I mean, I think that's where like the concepts of hubs come in, right? So obviously, if you think about retail fintechs, e-commerce platforms, banks, telcos, the view that I have there is that they will act as a basis for creating an easier UX experience for folks to onboard into digital assets. I think if you think about Fireblocks as an infrastructure company, when we're working with banks, there is a lot of integrations that we have to do to existing systems, right? I think this view that if all of a sudden a bank can operate and take a stablecoin, there's a lot of utility behind that is generally fundamentally false, right? Because at the end of the day, what benefit is there if you can make a payment in real time via stablecoin, but your internal systems can only reflect that payment on Monday? Right? So at the end of the day, you have to think about how you change your GLs. You have to think about how you change your payments engines. You have to think about like integrations of travel rule and all of these different capabilities into the core, right? To reflect the kind of real value that the technology provides, right? And so I think when we're working with banks, like a lot of our effort is spent around like what are the critical components that need to change to allow people to recognize the value that they see with other firms that are built from net new stacks, right? So if you're interacting with Coinbase or with another digitally native technology player, they've built a lot of that infrastructure from scratch. They've thought through the problems of reflecting those type of payments. And so if you're a traditional player, your ability to really change those components and kind of at least at a minimum level meet the kind of expectations that the market has around the technology becomes a bigger part of what you have to solve for.
Yeah, and well, we're going to the end of our panel here. In one phrase, Stephen, for those who say, hey, maybe crypto, it's too early for crypto, maybe it's not ready on an institutional level, what would you say to people saying that the infrastructure not ready yet? You know?
I mean, I think it's coming, right? And I think the firms that are innovating are building models that people will see as disruptive. And if you're behind, it'll be very hard to catch up.
Cool. Well, thank you so much, guys. Thank you, Stephen. Thank you, Dan. I hope you have enjoyed our panel here. Just 3 remarks here. Dan mentioned some platforms that, like DeFi Llama, would say also RWA.xyz, that consolidates a lot of info about RWAs, real world assets tokenized, and put us on the top 5 MB as the top 5 private credit issuers in the world. You talk about comparing the GDP of some countries, you know, to the stablecoins market cap. The other day, I found that Mercado Bitcoin, with over 4 million clients, have more clients that Uruguay have of people there. So it's a lot of people. And well, that's all. Thank you.